So welcome everybody. We are trying to run these presentations every couple of months. We don't have the exact date every single time, but if you attend one, we will certainly let you know about the other, unless you tell us we don't want to come back for any more. We aim to give you a variety of opinions, and we try to have two presentations in the one session so that you get a different perspective of the same topic. And then from our panelists, we try to answer questions and give you some feedback in specific areas. If you need a specific question answered, feel free to contact us and send some information through, probably through the BGES site is the best way to go, or the person that invited you here. And we're certainly, all our members are happy to have a chat to you, and no obligation, no charge, just to say hi and see if we can help that situation for you. So I'll now like to introduce Eric. And Eric, if you'd like to put up the first slide that you've got, thank you very much. So folks, Eric helps a variety of clients in strategic business growth and exit strategies. His career started with Deloitte Haskins and Sells. It's a very well-known company in Australia from many years ago. Along the way, he's been successful in leading and significantly improving Australian companies in very senior roles. Companies like Avis, Jaguar Rover, Audi, Daimler, Chrysler, Hyundai, including being a general manager of a $1.4 billion per annum company. Back when 1.4 billion was some serious money, it still is today. Leveraging his holistic and multidisciplinary approach, he achieved business success for the big companies before he decided to move into management consultancy. I've known him for over 14 years, and he's consulted to accountants, tradesmen, building companies, business coaching and educational companies, to name just a few. He's passionate about helping businesses, and he's passionate about them achieving their goals by bringing in independent views and expertise to complement the SME team. And his main objective with you is to be producing exceptional, cost-effective outcomes. He's a strong believer in business acquisition and business growth, but he insists on him also working towards future-proofing your business and always looking to improve your exit strategy. He has an MBA, he is a chartered accountant, he's a fellow of the Institute of Managers, and for me, he is the show me the money man, but with a great spirit, a great soul, and a great heart. I give you Eric.
Thank you. So during the presentation, I will share with you the current business exit landscape, why a strategic business exit can lead to the best return for business, and how to set strategic direction for strategic business exit and value improvement, and what are the critical elements for strategic exit or action points. So to start with, I would like to share with you the current business exit landscape. See, a lot of us, our business is our most valuable asset. We hope when we exit our business, we will have enough resources to retire comfortably. I just want to share the recent statistic about business exit. In fact, it is a very crowded market with very few buyers. So based on the Australian Small Business and Family Enterprise Ombudsman data in 2020, small businesses that have a turnover of under 10 million account for 98.4% of all businesses in Australia. I think that most probably will fit in with our attendees' businesses. And interestingly, over 19% of small business owners are over 60 years of age, and 40% of small business owners are aged between 45 to 59. So what it means is that 59% of the small businesses are over 45 years old in terms of business owners age, and might be exiting now or in the next 10 years. Can you imagine there will be 1.3 million businesses that might exit now in the next 10 years? There's big numbers there. Another interesting landscape is that based on a lot of research and report out there, most businesses do not have a business exit strategy or plan. Why? There are three main reasons. The first one is they think they are not going to exit now, so they don't have to deal with it. The second reason is, well, they are too busy at the moment. So business exit is in the bottom of the pile. And the last one, quite often, they want to do something, however, they don't know what to do. They don't know how to strategize. They don't know how to plan. This is where, we and the panelist team most probably can help. Now, why a strategic exit can lead to the business return for your business? I think all the attendees want to find out about that. I'm actually a natural optimist. I have optimist outlook. I always think that, things will turn out well, and eventually always light at the end of the tunnel, and always silver lining, even during COVID-19. But as a business strategist, what I believe is that if you spend your time strategizing your business right from the beginning, and then implementing key action that will grow your business, sustain your business, and exit your business successfully, definitely you can achieve much better outcome. So there are three areas that I want to share with you today concerning strategic business exit approach. The first is strategy-based methodology to compete in the crowded market. I will actually go through the detail in the next slide. So strategy to me is like a big picture roadmap that create direction for a company to move forward. So if you want to build a dream home and you've got all the different requirements, whatever they are, could be entertainment room, could be a lot of other things that cater for your leisure as well. If you want to customize it for yourself, most probably you'll go to an architect. A good architect based on your requirement and what you want will actually create a drawing or a plan. So if they are really, really good, there is no boundary in terms of the solution that they can give you, that give you, the satisfaction and the wow factors. For example, the creation of the Sydney Opera House. Wow, that is really amazing. And at the end, it's actually become a reality. Now, the next thing is the key concept of strategic buyers. Those are the buyers that will value your business more than any other common buyers. Just give you an example. They could be your competitors who want to buy your business because they want to expand. They might want to expand, in terms of different niche market. They might want to expand in certain geographic areas. They might want to expand because you got good reputation, and it would be synergetic services for them. Okay. Another potential strategic buyers is actually your management team and your staff. They might be interested in buying a business. One, to protect their employment, give them certainty. Two, they are actually an owner of the business that they are familiar with, and more importantly, they are passionate with. And another interesting area of strategic business buyers, except the time frame, and you got to plan it very early as well, is overseas buyer. Australia is such a beautiful country. Even COVID-19, we are still doing reasonably well. Our education system is marvelous, weather is fantastic. And certainly the government, in terms of the way it works is quite, stable. So they might want to come here and thinking about staying here, buying and running business here. there could be another strategic buyer that might, give you more, because they have certain and specific intention there. And could be listed company. A listed company actually no-brainer, because normally the way they are valued in the market most probably would be between 13 to 17 EBIT. There's an accounting jargon. EBIT means earning before interest and tax. Really is a profit. And if they buy you from the multiplier even 5, once they acquire you, suddenly automatically turn into 13 times of 17 times. There's certainly a no-brainer as well. And there are other strategic buyers as well that I can maybe give you some example a bit later. So it's important to understand not everybody is the same in terms of how they look at your business. And the last one is you need to have a clear roadmap and action toward great outcome. So once you have a strategy-based methodology, identify your strategic buyers, you need to know what action you need to take to be able to achieve your end goal, which is the exit of your business. So how set strategic direction for business exit and value improvement, how to set them, okay? So this is based on the methodology that I have created during my study, my doctorate study here, right? I did my doctorate in business administration. So the understanding of industry and trend is certainly very important. In other words, you need to understand the industry and what is the trend, right? And that is certainly quite important. And also need to understand the key players. Not necessarily the key players would be your buyer, but the key players give you a flavor of what the big guys are doing. In these two areas, IBIS World research normally is a good source. We do use quite a bit of them for our client. They actually give them pretty good view about industry trend and all the different areas that you need to know. Now the next part is very important part. We will actually perform business value driver and risk assessment. There are 10 key areas that we assess business with. Let me share with you what are those 10 key areas. They are talking about the industry, business performance, business growth, business risk, competition, systems, owners, staff, customers and market demand, succession and estate planning. So these 10 key areas actually will drive the multiplier of your business. Now let me explain that a bit later. So you need to come up with a baseline. The baseline is you should establish the fair business value as is, so you know where's the starting point. Right? We actually use the methodology approved by accounting bodies and bankers to come up with a fair value. In fact, we also produce a benchmark report so you can see where you are in comparison to other businesses in the same area. Now, for a lot of businesses, the business value is driven by your profit, or EBIT in accounting term, times the multiplier. Now in SME, the multiplier can range between 0.5 to 3 normally, right? And the 10 area of the business that we assess will show you where you are and where can you improve to move your business value forward, right? And certain business we understand is not based on that, like accounting firm and legal firm, most probably dollar to revenue sort of concept, and some restaurant and all that use the similar concept. Okay. Now, identifying potential strike buyer who will value the business more, right, is the next step. And then you can create roadmap for business value improvement and strategic exit after considering of the 5 elements I've mentioned. Of course, during the journey, you improve key values and appeals that will be, much appreciated by them. And the last part is actually very critical. You got all this done, it's all fantastic. You need to establish the strategic exit sales channel and process. Right? Now, with our experience, when you have a lot of network like us, knowing a lot of accountants, a lot of lawyers, a lot of business brokers, business owners, overseas connection and all that, that will actually help you to be able to, communicate to them about your business, normally in the form of information memorandum, and get some interest accordingly. And of course, you can advertise through business brokers and through your connection, and even directly, approaching the potential strategic buyers. I just want to share with you some good news stories and case studies that we have done. So give you a bit of flavor what actually can happen when you do a strategic business exit. So the first one that I want to share with you is a marketing firm came to us. The marketing firm actually got 8 team members and the turnover was 1.5 million and made $180,000 profit. So we have gone through the strategic business exit. We understand this area is actually quite crowded. A lot of players are actually non-employing, and majority are micro businesses employing between 1 to 4. There are some small ones as well. So we know that possibly their competitors might be interested in them, but more importantly, we have decided to focus on management and staff buyout. So actually it took us 4 years to improve the value of the business by having a look at the 10 key areas. But very importantly, also make sure that we focus on the areas that a manager or staff will really value and appreciate. That's including obviously the branding of the company. We actually improved the branding of the company. In fact, we tweaked the branding a bit. And the type of client and having a CRM system, obviously they want to be able to manage the marketing and sales and automate them. And the team members, they want to make sure that they have a combination of skill set in their niche market that people will be happy with and give them competitive advantage. So at the end of the 4 years, we managed to recruit a manager and a staff who would be interested in buying the business. In fact, we managed to successfully exit the business for $680,000. So they would be like more than 3 times of their original value when they engage us. And in terms of multiplier, is around 3.1, which is pretty high. Normally in the type of business, most probably the multiplier is 2. And that is certainly great success stories. But as we said, it's a journey. It's not that, you work on it today and suddenly in 2 months' time, you can exit your business, with a great value. And another case study that I want to share with you is actually trade services business. Trade services is actually quite interesting. A lot of them, especially non-employing and micro one, they think they cannot sell the business, and when they finish, they just close shop and finish, that's it. All right, I've been there, done that, we close the business, see you later. So this particular business owner actually quite forward thinking, said, right, okay, I want to realize, some money from my business. They've been working on it for a long time. It's their blood, sweat, and tears, and they approach us to see how can we go about it. So this particular business got 70 members. Their turnover is 1.1 million, and their profit was $130,000. And we actually value the business at $150,000. There were actually a lot of areas they can improve to produce better results. But first and foremost, we also want to understand who could be the strategic buyers. Right? We work out the strategic buyers are actually few of their competitors, because we have done the business assessment early on. One of the area, obviously, competition. Right? So we actually work out few of their competitors could be a good buyer. So what we have done is we actually start to build a good relationship with those competitors rather than making them enemies. And took us 2.5 years to get a competitor who wanted to acquire the business. So they exited the business for $420,000, and so that would mean nearly 3 times as much as when they started, and with the 2.8 multiplier. In the industry, most of it multiply normally 1.5 times. So once again, that was another great success story. Another thing that I just want to share with you as well, at the moment we are working with a legal firm for overseas strategic buyer. Now, with the lawyer briefing, we understand there are certain key areas that the business need to fulfill, including that their bottom line or profit should be at least around 1 million, because they need to invest $2.5 million in Australia. And if they have a regional office, that would be beneficial, because that's one of the criteria that favored by the governments. And another thing is employing, at least more than 4 people. So those are the criteria that we are working on. It's still in progress. We believe it might take a bit of time, because the process of getting the visa and all that actually quite lengthy. So we hope by the time we finish, the business owner should be able to realize maybe 4 times EBIT or 5 times, which is really good result. Just share a couple of other creative project we have. I'm just mindful of the time. One of them is actually grouping 5 different non-employing advisory firm and micro businesses, because on its own they are too small. So we are in the process of merging them into a bigger quantity and bigger business that provide better value, more holistic services. They would be more valuable and more interest to the buyers. So we are doing that. Another interesting project we have, which is a bit unusual, is a startup project. They got really good IP. They say, look, we are not necessarily going to be a unicorn, but we want to explore what do we need to do to be able to get, some investment along the way. So we are working on that. One of the solutions is that, that one of our clients, even ourselves, we are happy to invest and take, partial ownership if there is a great potential. So those are some of the case studies that I want to share with you, at least give you a bit of flavor, what is actually can happen, and some of them could be relevant to you or the people you know. What are the critical elements of strategic exit? This is most probably the action point that I want to share with you. Number 1, have a business exit strategy. Number 2, have a pragmatic implementation roadmap. Number 3, this is very critical. Start as early as possible, because it's going to take a few years if you want to achieve exceptional results. The last one is, like through the survey and all that, they are stuck because they don't know what to do. So get help when needed. Well, everyone will have a choice. If we take action with the business exit strategy early, we can reap the benefit. If my presentation and my co-presenter and panelists Q&A resonate with you, please contact us My contact is eric@bges.co. Our website is bges.co. I'll be more than happy to answer your question or explore further in the Q&A or when you contact me. Thank you.
Thank you very much for that, Eric. And whilst I'm allowing Martin to take control to put his presentation forward, I just want to thank you for sharing those. Eric gave you some case studies, and the reason we share case studies with people is for you to listen to the story and see what part or what character you could play in that story for your individual business. So it's not just about, oh, well, that's interesting, you did that for somebody else, but how does it work for me? That's what we start to work together with you on, or your advisor should work together with you on. We talked about having a strategy, and if you don't have a strategy in whatever you're doing, you're nothing more than part of somebody else's or something else's strategy. So to me, in business, if you don't have a strategy, you're just like a cork in the ocean. If the wind blows east, you're heading east. If the wind blows west, you're heading west. If the tide's going one way or the other way, that's what's happening with you. Having a strategy gives you the engine, the sails, the steering, so you decide where you want to go, irrespective of the weather, irrespective of the tide. So think about your strategy to have control of where you take your vessel. That's your business and your life. Martin, are you about right to set your presentation up?
Yes, ready, George.
Okay, well, if you just bring up your first slide, Martin. It now gives me pleasure to introduce you folks to Martin Collins. Martin has been practicing as a solicitor for, I think, about 1986, and he currently operates his offices up in Sydney's northwest. Over the years, he's been providing services to small and medium businesses, which are really the backbone of the economy. And our group in general is interested in SME and the smaller businesses. Most of us have had experience with corporate, but we choose to work with smaller businesses. And he wants to focus on maximising their return on their time and the treasure that they've invested in their businesses. He provides advice on shareholder partnerships, deeds, terms of trade, purchase and sales of business. He also is a Master of Laws, Applied Law. He's majored in wills and estates, so that is great for him to assist his clients in preparing for that time when their exit plan has to be put into practice and action. Whilst he's a lawyer, and he'll always guide you by the law, he also brings to his clients a pragmatic and commercially realistic approach, which I always enjoy when I talk with Martin about clients' issues. This allows your decisions to be not only legal, but realistic and commercially viable. Great pleasure to introduce Martin Collins. Take it away.
Thank you, George, and good morning, everyone, and thank you for joining us today. Yes, today I'll be talking about business succession planning, and my lead-off, I'd like to use this definition that I obtained from a Queensland business government website, and the areas that I wanted to concentrate on here is right here about a smooth transfer of ownership and management. Eric has well spoken about long-term planning and strategic planning in terms of selling a business in in a set period of time. But business succession can happen at any time, in the sense that something can befall you, such as illness or injury or COVID, and you need to have a plan B. So there can be those emergency situations that appear every so often. or you can, and at the same time, you can still be building towards a strategic exit over a longer period of time. A good example of this is a friend of mine who I hope has joined us today. He set in place a business succession plan with the children, two of his children. More recently, unfortunately, he had a fall, badly damaged his shoulder, but he had the planning in place, those structures in place where the business could continue. His children, who were well trained and well across their briefs, could move things along. So there was no breakdown in how that business continued and continues at the present. So I'd like to talk first about basic documentation for everyone when considering what fallback, what structures they need behind them as small business people to prepare for anything that may occur. And the first thing has to be an up-to-date will. Most recently, a client of mine who kept coming into the office, kept saying he'd come back and change his will. Sadly, he passed away. His will went back to 2004. In the interim, his wife had died. She'd been his first choice as executor. And his then choice was his brother-in-law. The brother-in-law had no idea about business, or has no idea about business, and no interest in running a company. It was very specific in dealing with electrical installation. And so at the moment, that company is in a void. It's in a vacuum. There's no one to take the place. He does have a son who is going to step in. So when you're making a will, it's important to have that will up to date, to have that and to choose an executor or one of a number of executors who can take over your business and assist in keeping it going and step into that role that you were occupying, if only in a management sense. So question whether your spouse or your partner in life is the best person to do that. He or she may well have your best interests at heart, but may not have the business understanding that is needed. And certainly you can have joint executors to cover that situation. Background to the will, perhaps there are certain instructions that you need to give that can be placed with your will about how to continue the business, perhaps some background guide that would fill in some of the gaps. Along with that guide, who knows all your passwords, how to get into the computer, how to get into your bank, how to access the software that you're using all the time. I just wanted to move slightly off track by talking here about cryptocurrency. Not many people have a great or a very sophisticated knowledge of cryptocurrency, and it does have very specific requirements in terms of wallets and exchanges and holding information in devices. That information needs to be conveyed to your executor and available to your executor. Otherwise, they'll look at a bunch of devices and might just throw them out, not realizing their value. Finally, if you're a member of a family trust, you may, and it is your family, or you're the head of the family, you may well have been made the appointer in the trust deed. The appointer is the person who nominates or replaces the trustee of the trust. And generally, that appointment is made through a will. So if you are in a family trust, make sure you instruct your solicitor about that situation and that the will covers it. Power of attorney, very important in the incidents where you do have suffer illness or an injury and you're not able to maintain or manage the business. You need someone there who can do that, to, again, step into your shoes. It's important when putting together a power of attorney to make sure you have specific instructions or authorities concerning dealing with the bank and bank accounts or dealing with property, because banks and financial institutions are very reluctant to simply act on a general power of attorney that doesn't give those specific powers. So you'll assist your attorney if you include those powers. The ATO, if you're in a self-managed super fund, the ATO requires an enduring power of attorney because it doesn't want a vacuum in the trustees if you happen to be ill or traveling overseas for a long period of time, if you can remember traveling overseas for a long period of time. You can also use the power of attorney to appoint a director as a substitute during your absence or illness, and perhaps you would consider putting in some specific powers either into or having a board minute to confirm that that power can, or that director can be appointed as a substitute. That's if you're sole director. If you're on a board, that should be considered by the board. Your company as well can have a power of attorney. Most often I've seen this in situations where the company is doing major repetitive financial or legal dealings, such as a major subdivision of a property where there's constant repetitious signing of contracts that are basically all the same. They will often appoint one or two members of the solicitor handling the transaction as being their attorneys for that specific power to do those specific jobs. So the company can certainly be ready to appoint someone and action that when you're in some sort of difficulty. You can also appoint an alternate director and have board minutes reflecting that appointment. Just keep that to the side, and of course inform the alternate director that their appointment is there, and that will allow them to step into the role should you be unable to continue the business, or to and you want to make sure that you have representation on the board if you're in a major company. Now, if you are in a larger company or in a partnership, it's a good idea to have shareholder and partnership agreements. These are basically the same document, but applying to those different legal entities. And they have very similar terms and conditions. I've only highlighting here the issues of strategic business succession, rather than covering everything that should be covered in a shareholder and or partnership agreement. So I'm just concentrating on that particular issue today. So obviously the first thing that we would consider, or you would want to have included in forming such an agreement, are conditions surrounding admitting or terminating partners, directors, and shareholders. Usually you will see terms around if offers are going to be made, or if out to partners or to directors or to someone to give shares to, that be approved by all the members and only done under specific terms. If someone wants to exit, then they will, as a shareholder or as a partner, will offer their shares back around to the others first, before then looking outside the business to direct to sell their interest in the partnership or the company. Now, it's then important in the agreements to give interest or consideration to what would happen in the event of death or permanent or temporary disability. And key man insurance plays a very important part in this. It is important as a shareholder or a director to allow the business to continue and to continue to trade and to not be placed into a serious financial situation where it has having to find money to pay out a partner's interest or to pay out to protect shareholdings. In the situation where a director, major shareholder or partner has died, his or her estate, they're just going to be interested in seeing a return on that investment, on that asset, for the benefit of the beneficiaries, and they're not particularly interested in how the business is going or what might affect the business. By having key man insurance in place, then the funds are immediately available to pay out that interest. It's not affecting the business, it's not dragging the business down. The estate is paid out and the business moves on. It's a very effective method of dealing with this unfortunate situation. And it's important to make sure that the agreed value of that partnership or shareholding is updated and reflects the actual value of the interest that is being paid to the estate. Short of death, life happens. A shareholder or a partner can suffer a permanent or temporary disability. Now, normally a company or a partnership can hold it together for 3 months and see how that injury or illness has affected the specific person. But if they remain disabled or their illness is going to take a lot longer to recover, and you're seeing that with COVID, they're talking about long-term COVID. It's affecting people's mental facilities. It's taking them time to get their head straight, to get back into business. So disability cover is important. That again takes over the financial cost of that shareholder or partner. They're getting an income stream, and it's not dragging the business down. Moving on to determining goodwill, I've discussed that with the key man insurance, and that should be part of the how to calculate that should be part of the agreement. Factors on retirement. If a partner is leaving, it is important to have restraint and notice periods in place. It's so often I act in sale of business where the purchaser is telling me, oh, he just, so-and-so just wants to retire. You never know. They change their minds within a year or two, and you see them down the, you have a coffee shop and suddenly the vendor's opening another one just down around the corner. So restraint and notice periods maintains the value of the business. The partner's moved on, the director, shareholder has moved on, and his or her, he or her won't be making any sort of challenge to the business in the future. Eric has talked very well about strategic exit and putting that into place. Drag along and tag along conditions are very important in a shareholder and partnership agreement. Most often, especially in a partnership, you have a mixture of older and younger partners. It can also happen in business with directors. Often the older ones are the ones looking for the way out, looking for the white knight to turn up. Drag along means that if an offer is made to purchase the shareholding or the partners, or to buy and do a buyout, the majority, the older directors perhaps, can force the minority to accept that deal and drag them along to bring it to a conclusion. Tag along is for the benefit of the minority. If they're not happy with being bought out, if they find that they're, like on Survivor, going to be on the weakest team, they can demand that they get the same value for their shares as the majority. So that protects their interest if they want to exit, or they feel they should exit at the same time. Issues for a family trust. So a family trust is often a method of business investment. Discretionary family trusts are a good way of using an income-producing asset and distributing that income amongst the family and for the benefit of the family in the long term. Many older trusts still have, will often have individuals as the trustees. It's much more effective and much more flexible to have a corporate trustee, and then they can be moved in and out, or directors can just come and go without a great deal of having to change documentation and ownership of assets. It's a much better way of going, and especially with a self-managed super fund. It's important to identify the property that's held in the trust. This may seem obvious. I recently had a client instructing me on a will. One portion of the will, he has always intended on his passing to give a portion of his shares to a valued employee who he would want to consider or continue in the business and maintain the value of the business. What he didn't realise was all his shares were held by the family trust. This employee is not a beneficiary of the family trust, so those shares are locked up in there, and he is now trying to find a way of moving around and getting those and giving that employee some sort of benefit that he had always intended. I mentioned real property here as well. It's always useful to have corporate or commercial property in a trust if you're running a business from that property. I did have a situation where, well before I was involved, a family trust had been used to buy homes for two of the children in the family. It was all very lovely at the time, but over time, the children didn't see value in putting money into the house because it wasn't in their name, and the houses didn't end up being their dream home, and they wanted to move on. But this created a whole range of issues in terms of capital gains tax, and they were just going round and round in circles for many years. So being very careful about what assets are put into a family trust. Keeping the family trust up to date is very important as well. You may have been aware of the change with the foreign person stamp duty, the excess for foreign person. There was a big rush towards the end of last year to make changes in discretionary trusts. Sadly, some people missed the boat on that, and the land tax excess is a killer. It was really expensive. So very important to make sure your trusts are kept up to date. And it's often the small trusts that are started up with big plans but go nowhere, that they're the ones that often fall into these problems of not being up to date. Named beneficiaries in a family trust, families split up, depending in a family law situation, who ends up keeping the family trust, like keeping your friends, who ends up in the trust. You've got to make sure that the other party, the other spouse, comes out of the trust. They're most often a principal named beneficiary, and they need to be removed, and there's certain documentation that's needed for that. Just quickly to finish off, when you are preparing to sell a business, in terms of legal requirements and putting a contract together, you need to make sure your employees all have up-to-date employment contracts, that their entitlements are being properly calculated, and that they have restraints. If you have key employees that you want to sell as part of your business, you want to keep them, if you can't, at least keep them in there, that they are restrained from going out and doing their own thing and damaging the value of your business. Premises, do you have a registered lease? Is it registered on title? Is it up to date? Is there an option? If you have a lease that has a number of years left in it, most likely you'll be assigning that lease, which does keep you committed to it to back up the purchaser. Clients have written client agreements, service agreements with them. Make sure you know who that you're dealing with, the correct legal entity. So often I've seen clients chasing debtors and they don't have the correct name, they don't have the ABN, they don't have the ACN, the guarantor. Make sure you have a guarantor, sole director company. Terms of trade, keep them up to date with the payment terms and limiting liability. Intellectual property, having the registered trademark. These are things that Eric spoke about and would be talking to you about. If you're in a business where you're developing product, patent applications, copyright, having a domain name for your website. So important these days is the website and the online presence with Facebook and all the other websites and areas that you can use. So look, these are just a few things on business succession planning. It can happen to you overnight, or it can happen as part of a long-term plan, but you need to know who's there to step in and take over when that occurs. So thank you for listening. Thank you, George. And I look forward to the question and answer session.
Thank you very much for that, Martin, and some great ideas and advice there. Folks, all the people within our group would like to do business with you. However, we are passionate about you doing business with professionals. So if it's not us, that's okay. Not one size doesn't fit all, we understand that, but we are passionate about people understanding things and about getting expert advice. Jimmy, the arm bending expert, who I have met hundreds of times in my life. Why do I call him an arm bending expert? His expertise is he's down the pub and he can bend his arm, and he is an expert on anything. They are not the sort of professionals we want you to be looking at. So if it's not us, we want you to find somebody that you're comfortable working with. Many years ago, I heard this saying, and I share it with people on a constant basis. If you think I'm expensive as a professional, wait until you see what an amateur will cost you. Last night, I was looking at a document. Martin, your hair will stand on end with this. I was asked to sign a confidentiality agreement from somebody that I'm quite happy to be doing some work with. And I said, I'll sign the document because I know I can trust me, but I will get it resolved for you This person downloaded this document free, didn't cost them anything. So they didn't need to go to a patent attorney or a lawyer like Martin, or even a bloke like me that happens to know a bit about IP law. You ready for this, Martin? Clause 19. Either party may terminate this agreement by providing written notice to the other party. All rights and obligations under this agreement will terminate at that time. If I go back to the earlier clause, it says it's in force for 5 years. So what we're talking about here, folks, is this lady is sending this out, giving me confidential information and other people confidential information, because she's got a 5-year confidentiality agreement that either party can terminate. Get this one, Martin. Item 20. And this is relevant, folks, for what we're talking about in exit strategy. Except where either party has changed its corporate name or merged with another corporation, this agreement may not be assigned or transferred by either party in any manner, in whole or part, without the written consent of the other party. So let me explain this to you, folks. If Martin was your solicitor and you brought this in and told him that you had signed it, he would be contacting one of us and saying, who do you know who can fix a heart flutter? What that says there is, unless that person changes their company name or merges, if they do any other sort of business deal, like working with Eric and I and you and whoever, to sell their business to another company, so sell it, not merge, sell it. If they want to license, if they want to do anything, I am no longer, I can stop that from happening because I don't give permission for the confidentiality agreement to stay in place. So Eric's about to buy your business for 5 times your turnover, and I say, that's great, except I don't give him permission because I'm not going to continue this confidentiality. People, if you're not using us, you need to find people that resonate with you and you can trust them. And I repeat, Jimmy, the arm bending expert, is only good for one thing. Eric, over to you.
Yes, thank you, George. Thank you, Martin, for the presentation, sharing the legal perspective we ought to be aware of. And now is the Q&A session. So first of all, I just want to introduce the panelists. So if you can just wave your hand when I mention your name, that would be good. George Mafros, I know they know you. You're Associate Partner for Business Growth and Exit Specialist, focused on sales, marketing, and intellectual properties. And we have Lena Chung, Principal Solicitor, MLC Lawyers, specializing in immigration and family law. And we have Ronell Wilson, Partner at CIP Accountants and Advisors. And we have Milin Kulkarni, Digital Transformation Leader at Smarter Information Systems. Good to have all of you here, and much appreciated. Now, we actually got several questions in the Q&A. So if you allow me, let me go through them so we can share the I guess, answers from different perspectives.
Eric, did you notice Terry's question? He put that in relatively early.
Yes, we actually got like 12 questions so far, George. So let me run through them, and I'm pretty sure we should be able to cover them. Okay. So I think the first question you said very early on from Terry is actually asking, do you also advise and factor in forced exit, including medical and death, etc.? That is actually quite a good question, because when we go through the journey of business exit, don't forget, we always focus on strategic business exit. We got to understand the whole picture, the different major components, a lot of them being explained by Martin. So when we do that, part and parcel of that is the management succession, right? So if the key people is going to fall ill or for whatever reason cannot be there, do we have a backup, right? And how are we going to nurture that backup? This one way. The other one, obviously, as Martin says, you need to have, the sort of enduring power of attorney in place. And thirdly, systemization is always the best, because then the business should be able to run on its own, disregarding whoever going to come or go within the company. And really what we are trying to do with all those components, be sales ready. When thing happen, at least you got all the major component in there and you have progress as far as you could. And then with some of the legal matter being addressed, you should be in relatively good condition. So Martin, do you want to maybe address that question as well?
Could you repeat the question?
Yes. So basically the question is, do you also advise and factor in the forced exit, like medical, death, etc.?
Oh yes. Well, partly that response has to come from yourself, in the sense of the planning has to come from yourself in identifying the people that can take that role on your behalf. And we can certainly advise you on the structures or the documentation that you need to bring that into place. As Eric said, it's about systemization, so that the people who you have on the bench ready to move know their roles, know what they're going to have to do, and know how to fit into your business and make it and ensure that it keeps going. If that business is systemized, then really it's just a matter of keeping your hand on the levers and making sure the bills are paid and the employees get paid. That's and keeping the cash flow. Yeah, certainly we can assist with that, but you're going to have to look at yourself, look at your structures, and look at who you believe can take control in the situation.
Yeah, thank you, Martin. So just mindful of the time, I just want to go through the 11 questions in the next half an hour or so. The next question is, this is an interesting one. So for overseas business buyers, how can they come to Australia to explore any business opportunities? So most probably, Lena, you'll be in the best position to address that question.
Thank you. That's a good question. But to come to Australia to explore about business, to buy the business, there is no specific visa for that. But the buyer or the applicant can actually come under tourist or family visitor visa to come and then explore to buy the business here.
Okay, thank you. Looks like there are quite a lot of questions for lawyers here, but let me just go to different question. Well, this is really ultimate dream answer that we'll expect most probably from Ronel. He said, I understand it's possible to sell your business tax-free. Can you outline the condition under which this can be achieved? Ronel, I love that one as well.
Yeah, there certainly are some conditions. Number one is if you make a loss, you won't have any tax, but hopefully that's not what will happen.
Mm-hmm.
So hopefully you make a profit on the exit of your business. And the main tax concessions you can get called the small business CGT tax concessions. And it's a set of rules that business owners can avail themselves of if they meet certain tests. There's quite a few hoops to jump through. The main two tests are a $2 million turnover test or a $6 million net asset test. And there's other tests as well if you're in a company or a partnership with ownership structure and that sort of thing. But meeting one of those two tests, you don't have to meet both, but one of those two tests will get you into the small business tax concessions. And what they allow you to do is to reduce the capital gain by the use of various concessions. And if you're over 55, you can use the retirement exemption and take the proceeds without putting the monies into super. Or if you're under 55, you can use a retirement exemption, or you can even use a replacement asset rollover. You can use the net gain after using those concessions to purchase another business for the value of that capital gain. So you can actually kick that capital gain down the road. So there are certain conditions whereby you can get a tax-free outcome, but there are some hoops to jump through. The blanket one that is probably the most advantageous to you is that if you meet the $2 million turnover test or $6 million net asset test, and you've held the business for 15 years with similar ownership, you can actually get that tax-free, and that gives you, a blanket tax-free exemption straight up from the capital gain, and there's no requirements. But you do need to be over 55, and it has to be in consequence of your retirement. So that's the caveat there. So there are various ways of getting it tax-free, but it's really important to plan for that and to go through that before you make the sale. I've actually got a matter that's come from a referral source who's got this gentleman has just sold a business for 3.8 million, and he sold the business, but he doesn't actually meet the $2 million or the $6 million asset test. And had he spoken to his accountant before he made that sale, he could have managed the assets and probably got underneath that $6 million value. So these concessions are you're either in or you're out. There's no sort of phase in, phase out. You're either in and you get very good, generous concessions, or you're out or you pay the full freight of tax. So it's very important that before you do your sale transaction and set up the structure of your agreement, whether you're selling shares or whether you're selling the business, see an advisor, see your accountant or tax advisor to make sure that you can do everything possible to get within those concessions.
Yeah, thanks for that. I think once again, it's necessary to plan ahead and take into consideration all the different areas. Thanks, Ronel. Okay, let me go through some other question here. This one say you mentioned CRM a couple of times in your presentation, Eric. So how CRM is useful when trying to sell the company? I certainly can answer that, but I think Milin, most probably, you are in the best position to address that. Do you mind to address that question, please, Milin?
Yeah, sure. Thanks, Eric. One of the best benefit comes out of the CRM is having a system in place. So it is not only on the salespeople, because many times in a business owner have got so much information sitting down in their head, and as soon as they quit the company or they leave the company, that information is gone out of the company. So having that CRM system, the sales systems in place, the marketing system is in place. So whenever a new owner is coming up, that time they can actually just follow the system and proceed further. So the main benefit comes out is all the things is already sitting down in the business. The next person who is coming in, they just follow the process and everything is taking place. So that's why the CRM becomes quite important and useful for the businesses who are trying to exit the business. That's my view.
Very good.
George,
very good.
you want to say something on that?
No, I think you've covered that pretty well, Milin. The other benefit of a CRM when selling a business, you can run off all sorts of reports through your CRM, which can show the incoming purchaser or potential purchaser what sort of activity you've had with each client over what period of time. So I can have a very quick look at your CRM reports and I can see that you don't contact your customers very often, but they still buy. You do contact your customers very often and they buy, or you don't contact your customers and they keep dropping off. So yes, you've got good turnover, but you're also turning over clients as well as dollars. So a CRM can help the new buyer understand what they're getting into and be more confident about paying you the higher price.
Very good, thank you. So we have another question from that same person related to overseas business buyers. It says, understand if they come to Australia just to explore, Lina already mentioned the way to come in with this visa, and then once they are here, they can explore. But my question is, the next question is that for overseas business buyers, how can they come to Australia, not to explore, but to stay and run a business in Australia?
Yeah, that's a very good question. For business migration, the applicant must apply for a provisional visa first. It is under 2-stage processing time arrangement, but may apply for the applicant can actually stay up to 5 years after they've been granted visa to come under the provisional visa. Then they can continue to run the business and then can apply for a permanent resident to stay here up to 5 years. So it's very important that the applicants or the, you call it strategic buyer, to come and then explore and then buy the business. Because the processing time for the first stage can be up to 30 months. But the advantage for this, for the business sellers, is that the government has screening those buyers already. Like there are 3 types of business provisional stream. The first one is called business innovation stream. For this one, it's the requirement is up to 2.5 million. So that means the buyers already got the money ready to buy the business. So it's really advantage that the seller already knows that this potential buyer is got the money to buy the business. And also, because of the processing time, it takes longer. So the business seller have the time to prepare the business to sell as well. Yeah.
Good point. Thank you. Okay. The next question is most probably Ronel has answered that. Is there anything that needs to be done by a business owner prior to sale to minimize the capital gains tax?
You might need to have a look at the structure of your business. Some of those small business concessions are factored in. They factor in various shareholdings. For example, if you run your business through a trust, you've got to make sure that the stakeholders in that business get at least 40% of the distributions of the trust for more than 50% of the time that the business is owned. So if that's not what's happening, you might need to make sure that that does happen. So that's something you would need to do prior. And also structuring your sale proceeds prior. That's something that's important, because if there's going to be goodwill, or there's going to be goodwill plus assets, whether or not you sell the shares versus sell the business, that will have a different impact on where the sale proceeds would go. So if you sell the shares, you've got a mum and dad company, mum and dad get the sale proceeds in their pocket. If the company sells the business, the proceeds actually go into the company. The company makes the capital gain. And then you've got considerations as to how you get the money out of the company. So you'd have to get the money out of the company as a dividend. And so that will end up in the owner's pockets, but there may be top-up tax on that. So yeah, structuring the sale and structuring the company as well. So getting rid of any personal type assets or property assets that might be in the company that you don't want to sell with a business, and improving your balance sheet if there's any family loans in there, so that the balance sheet is fairly clean for the new buyer.
Thank you. This is a curly one. It's about IP. It says, how do you protect your IP, and how do you value your IP? George, I think you're the expert in IP, mate. Maybe you can answer this one.
One of the things that I quite often advise my clients to do is to retain the IP either in a trust somewhere or in their own name, and then allow the use, assign the use of that IP to the business, with a clause in there that if the business is sold or it goes into liquidation or whatever, the IP remains with the original owner of it. What that does is, if something untoward happens with your business, like you get wiped out by COVID and you want the businesses has to be sold off in that, but you've got IP in there that you could still use in another area, you have some rights to be able to pull that back. I saved a chap who went into a business with his 4 sons, who were always going to look after dad until the business got up to about $4 or $5 million. And suddenly the sons forgot who brought who into the business. So they started to make a maneuver on him. And I actually came in negotiating for the father. And I pointed out to the 4 sons that all the intellectual property actually was in the father's name, and it was licensed to the existing business. Suddenly the sons remembered that they were a loving, caring, sharing family, and things got sorted out very quickly. As far as valuing it, IP is like in the eye of the beholder. So it's a bit like the beauty is in the eye of the beholder. But there are various formulas that can be applied, and there's various ways that you can get what is an acceptable, realistic value. The important thing is, if it's not protected correctly, a la a dodgy confidentiality agreement that didn't cost you anything, then it may not be as good an IP as what you think.
Right, thank you, George. Anybody else would like to comment on that? Okay, I'll move to the next question. This is more general question. It says, what are the benefits of having good IT system? It seems that a lot of companies now heavily investing in IT system, especially cloud-based system, etc. Most probably, Milind, you want to address that question?
Yeah, sure. Thanks, Eric. One of the things which I see is, because before we put any IT systems in place, there should be a systems in place. And I think one of the area of expertise which Eric, you provide is looking into the systems and having a business process. Because once a business process is there, IT systems can be put on top of it. And whether it is nowadays, everything is going on a cloud. So the benefit comes out is wherever you are, you can connect to the systems and you can find it out, whatever information you are looking for and the decisions you want to make. So having IT systems, again, as like we talked about the CRM, having any systems in place is always useful. The main benefit comes out is whatever information you want to get out of the system, you can get it immediately. But any systems, as George also mentioned about, before putting the system in place, you have to think about how you are going to make use of it. So having a business process before, so it is not something like can be done at the last minute. 1 or 2 years in advance, you have to start thinking about it. Then you can put all those systems which can help you to increase the price of your company. That's from me.
Yes, that is certainly quite true. In fact, through our experience, when I discussed the 10 areas that drive values, certainly having really good, system and process is one of the key, not only, for efficiency, for agility, and certainly, for consistency, as well as, the business can run on itself much better. Thanks for that. Another
Eric,
question.
could I just add into that?
Yeah, sure.
One of the things that I've seen Eric do very successfully in his consulting, and I've certainly done it with a few of my clients, we'll meet somebody that's created the business and they've got processes and they've got all of this wonderful, wonderful information, 20, 30 years sometimes up here. But you're trying to sell your business. What Eric tries to do is to get business, and I've certainly followed on having learned from him many years ago, try to get the system to have an operations manual. Try to get the system to have a procedures manual. This is just as important as IT, but with the use of somebody like Milind, your operation manual, your procedure manual doesn't have to be a piece of paper. It can be within a self-learning computerized system. And when you come along to look at something like that as a new buyer, suddenly you're prepared to invest, because because you're not worried about what's in my 65-year-old head. You're worried about all the information that you can get. So when I first met Eric, he used to drive me crazy because he was always on about the systems and the procedures and all of that. But it makes a heck of a lot of sense because I'm not buying your body, I'm buying your business. Thanks, Eric.
Yeah, excellent. Thank you, George. Another question here, say, with regard to the retirement exemption, can this tax-free status still be achieved, even if there is not a lump sum payment, but instead a drip-fed vendor finance payment over a few years? So most probably Ronel in the best position there to answer this.
Yes, it can. Yes, it can. That's a simple answer. Yeah, you can use the retirement exemption based on when you get the proceeds. Yeah.
Right. Yeah. Thank you. And I guess most probably we got time for one more question here. We got 2, 3 left. Okay, let me pick this one then. My business operate in a company structure. Is there a benefit to selling the shares in the company or just the business itself? Which I think is a good question. So who would like to answer that, Ronel?
Yeah. Yeah, we see both in practice, so sales of shares or sale of the business. It goes back to the point that I raised before. If you sell the shares, the cash goes into the hands of the shareholder. So that if that's mum and dad, the owners of the business, owners of the company, if you sell the business and you're in a structure like a trust or a company, it's that trust or company that will make the gain. That'll make the capital gain, and that's where the proceeds will go as well. So it's not so difficult in a trust; it can come out to beneficiaries. But if it's in a company, it is somewhat harder to get out tax-free, and you can drip feed dividends over the years, or you can make loans. But it is a little more difficult to do that. It's really about the cash, and the higher the value that you can get for goodwill, the better your tax outcome will be within the business. If you're selling a business with various assets as well, the assets such as inventory and fixed assets, they'll be sold as if they were sold to any third party. So that's not a part of the capital gain. The capital gain really arises on the goodwill. So it really depends on the appetite of the purchaser and the seller, because often the seller will want to sell the shares, but the purchaser may not want to buy all the history of the company that might be within it, any potential warranties or claims, that sort of thing. It's often safer for the purchaser to buy the business and cherry pick those assets that it wants to buy.
All right, thank you. Looks like we are going to be running out of time. So thanks for all of you to attend this. If you have any further queries and our presentation or panel discussion resonate with you, you are more than welcome to contact us at info@bges.co, and we certainly would be happy to continue our discussion then. And finally, I would like to thank Martin for co-presenting, George, Lina, Ronel, and Melin for sharing their expertise and answering the Q&A. And we hope to see all of you next time. And thank you and goodbye.
Thank you.
And have a nice day. Bye.
Thanks, Eric. Thank you, everyone.
Thank you.
Bye.
Bye, everyone.
Bye.